Stocks are closing out the week on a strong note, and the reason comes down to one thing: bond yields are falling. US equities climbed broadly in recent sessions, putting major indexes on track for their best weekly gain in roughly 2 months. The driver is a pullback in Treasury yields, the interest rates attached to US government bonds. When those yields drop, something important happens in markets. Borrowing gets cheaper, and stocks, which compete with bonds for investor dollars, start to look more attractive by comparison. Both forces tend to pull buyers back into equities. That is exactly what appears to have happened this week. To understand why this matters, it helps to know where markets have been. The past several weeks were choppy. Investors were wrestling with uncertainty over Federal Reserve policy, sticky inflation readings, and constantly shifting expectations about where interest rates are headed. Bond yields had been running at elevated levels, and that weighed on stocks, particularly the growth-oriented names that are most sensitive to rate changes. When yields fall from those elevated levels, it can mean a couple of things. Bond investors may be growing more confident that the Fed will not need to push rates significantly higher, or it may signal that the economic outlook is softening, that weaker growth ahead justifies lower returns on safe assets like treasuries. Neither interpretation is straightforwardly good news on its own. But in the short term, falling yields combined with reasonably stable economic data tend to support stock prices. Investors appeared to take that view, bidding up shares across a range of sectors. This week's move also highlights just how sensitive markets remain to the interest rate environment. The Fed has kept policy restrictive, meaning rates are elevated, to bring inflation down. In that environment, even a modest shift in yield expectations can ripple quickly through stocks, bonds, and the dollar. Markets right now are finely tuned to any signal about where rates are going next. Still, 1 week does not change the underlying picture. Inflation remains above the Fed's 2% target. The timing of any rate cuts is still uncertain. Global growth risks have not gone away. Markets have given back gains quickly before, and they can do so again when conditions shift. The key data points to watch in the weeks ahead are jobs numbers and inflation readings. If those come in hot, meaning strong job growth or rising prices, yields could climb again, and this week's stock rally could fade fast. If the data stays calm, the bond market relief could hold a little longer. For investors following this closely, the practical signal is simple: keep watching yields. Right now, they are doing the work that is lifting stocks. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.